So, hi all, this is Akshara Menon from PMS Bazaar. So, today I want to welcome you all for an exciting webinar of the day on the topic Outperformance through Pricing Power Advantage. To talk on this, we have an eminent speaker with us, Mr. Siddharth Bothra from Ambit Asset Management. He has work experience of over 25 years in this industry and equity research. Also, before joining Ambit, he spent his 18 years with Motilal Oswal Financial Services. He is also a fund manager of Coffee Can Portfolio. Also, his investment philosophy, where he believes quality and long-term compounding, clearly aligns with Ambit Asset Management's value creation over long term in a disciplined investing. So, without any further delay, let us understand more about the topic from the speaker's words. So before giving the podium to him, I would like to request all the participants to put your questions on the Q&A box, which will be taken after his PPT. Over to you, sir. A warm welcome again.
Thank you. Thank you so much, Akshara. And good evening, everyone. I'm delighted to be, in this webinar. And thank you, PMS Bazaar, for having me here. So as Akshara mentioned, the topic of our discussion today is, I'll just put on my PPT. So friends, in this webinar, I basically wanted to discuss on 5 things. The first thing is, we discuss a little bit on pricing power stocks. And, we discuss on some of the research done on, how pricing power stocks have done globally. So that's, gives us a background on why we look for pricing power stocks and, how they have done globally. Then, we do a little bit of a deep dive in one of our co-holdings in our Ambit Coffee Can portfolio, which is Zomato. And in a way, we kind of discuss as to why we feel it's a very rare pricing power play. Other than that, we then discuss on reversal of the post-COVID style anomaly, which, we have discussed in our newsletter in June and September as well. But, I think now it's really starting to play out in earnest. A little bit on macro and market update, if we get enough time. And then just a quick update on our ACCP performance. So, to start with, portfolios based on pricing power stocks outperform globally. So I wanted to start with a quote of Warren Buffett, where he says that the single most important decision in evaluating a business is pricing power. If you've got the power to raise pricing without losing business to a competitor, you have a very good business. So the focus and the importance we give to pricing power is, in a way seconded by none other than Mr. Warren Buffett. For him, this was the key thing. And, we are trying to learn, from some of the great investors. So, what I've done is I've broken down into, we often talk about pricing power and, we typically just associate it with some of the key companies because, they have a legacy. We know they are MNC or they are blue chip companies. But I wanted to, maybe start off with what are the characteristics of a pricing power company, because not necessarily, every company needs to, become a blue chip or a MNC and become very famous, and only then we recognize the pricing power. Often, if we find these characteristics and, if we think that the moats that the company have built are sustainable, the industry structure is such that, it's not likely to be challenged very soon, and we have some good management there, then, we can actually find some of these companies at a very early stage. And, as you must be knowing, the majority of the money is made before, some of these companies are really discovered as one. So the first point is raise the price of your product or service at or above inflation rates. It's the way to think about it is, if you are a commodity, you keep hearing often in channels or often companies talk about in their quarterly calls that, our margins fell because our raw material went up and, we will take time to pass on the price. So that's typically more or less an example of a company which does not have very high pricing power, or, often sometimes they are very cyclical, or companies which no real inherent advantages. This could even happen with companies with pricing power where, for an interim period, there could be a one a month or 2 month kind of a difference between when they raise. But essentially, the idea is that if you're able to raise prices above inflation without impacting your demand, it's one of the signs of pricing power. The other is operate at limited input costs that operate at or below inflation. So it should not be that, say, assuming if you are a company and your main raw material is say 40-50% of your sales, and say if that raw material is like a something of that kind, then your pricing power gets limited significantly. So you ideally would want to have a company whose input costs are, on a long-term basis, like growing at or below inflation rates. The third, which is a very important point, is that the business model is asset light. Because, for a pricing power company, if you have a business which is, very asset heavy and you have to always invest, then, there is anyway some kind of a pressure on you to operate your plants at high levels. So, often the pricing power is missing because a promoter has put in, say, 1,000 crore or a very large amount in setting up a plant. And if he feels that, he will not be able to operate it at optimum level without cutting prices, he would do that. So, the asset light is often one of the key things. And the last is almost low negligible debt. And these are companies then, who have the coffee can characteristics we so often talk about, which is stable earning stream, stable returns, and so on. So these are the characteristics we look for in a company. Now, I wanted to talk about a research paper done by Stu Ho. He's a Bloomberg, researcher. Basically, the name of his research paper is Pricing Power Everywhere, where what he did is that he first, researched on companies in US between 2007 and 23. And he created an index which were companies of pricing power. So one of the key things they use for identifying that is very stable gross margins. And he realized that, these companies not only delivered strong and steady equity returns, but they did it with lower risk. And they on a consistent basis, were able to beat the broad equity market benchmark. And post that, what he did is he even analyzed the same thing for the European market and also for the Asia Pacific, all the key markets. And the data that you see here, in all these markets, a fund created by finding companies only with pricing power typically beats most of the benchmarks of that particular geography. And they do it by taking lesser risk and giving stable returns. This is a data which kind of just shows how important this one of the factor of investing is. I'll now jump into Zomato, and maybe we'll talk about why we think it's a very rare pricing power play. So before we start with Zomato, I just wanted to, kind of quickly take you through what are the two key strategies most companies use. If you see any successful company, they are either differentiators. What do you mean by differentiator? That, even while their cost may be slightly higher than the cost in the industry, what they try and do is they try to increase the willingness to pay, which is, customers' willingness to pay, in the sense they create enough value that, you don't mind paying something higher. So think of it like when you buy from a FMCG company and it's a known MNC brand and it's a known brand. So you don't mind paying a 10-15% premium versus say a brand you don't know about. Examples of differentiators would be like, say, a Titan, a Nestle, an iShare, say in a financial company would be HDFC Life, the Metro shoes. And, we come to why we think Zomato would be here. The other is that, most companies you find is more of they are low cost operators. So what they try and do is they try and get their cost significantly below the industry average, so that, they are the last man standing. And then they try and sell you at a price which is lower than the industry average price. So these are the low cost operators. So examples here would be, a perfect example would be an Avenue Supermart or a DMart, Interglobe Aviation, to an extent PI. And now why we think Zomato is very rare is that very rarely do you find a company which has distinct advantage on both end of the value stake. They are typically tech companies or, monopoly companies. These are the kind of companies which are often not found in India. At least till now, we didn't have many such companies in India who have advantage on both sides. So we think Zomato is one where not only are they able to increase the, let's do a Porter's analysis on this. So what happens is that, if you look at the substitutes, there's essentially no substitute to Zomato for the food vertical. You just have ONDC where, the efficiency and the, punctual, those things are missing, reliability is missing. Or you have self-service restaurants, which, just can't compete with these guys with the kind of scale they have now. Then if you look at the threat of entry, because it's a duopoly industry, they are basically just two players. You have Zomato and you have Swiggy. Between them, they have a market share of 58 and 42%. What is more important is right now, as we speak, Zomato has almost the entire, while the market share is 58%, they have the entire profit pool. We believe that, in next 1-2 years, Zomato might have more than 60% market share here. But, more importantly, they will have more than 75% share of the entire profits of that sector. So it's almost like a monopoly kind of a player there because, you control more than 75% of the profits there. That's our thesis, because I'll come to that as to why we think, because, both on the cost side and on the revenue side, they have significant advantage over Swiggy even in food business. Then if you look at the buyer power, so there are crores of consumers, and they are so fragmented and diffused that they have no bargaining power with Zomato. And then if you look at the cost side again, on the cost side, there's so many lakhs of restaurants and many of them are undiscovered. So for them, having a platform like a marketplace platform like a Zomato or a Swiggy is a huge advantage. So again, they are so fragmented that they don't have much, kind of a bargaining power with a company like Zomato. The rivalry, as you know, is very low, because if you see just the way Swiggy increased the platform fees, even Zomato did. So if you see, both of them are, operating more like a Pepsi and Coca-Cola rather than trying to fight each other on the price side. So that's the best thing about the food vertical. Now, coming to the quick commerce, so Zomato has 3-4 businesses, but the two key ones are quick commerce and food business. Quick commerce today, for most analysts would account for around 55-58% of the overall value of the company. Here, what happens is right now, actually the threat is increasing significantly, because this is a business which is relatively very new. It's hardly a 1.5 year old. And a lot of the big players are wanting to come in. Like you must have heard very recently, Amazon wants to come in. Before that, a couple of weeks back, Flipkart mentioned they want to come in. Already you have a player like Zepto who's been very aggressive here in terms of pricing. So unlike the food business where, over the years, it became a duopoly and all the other players were taken off, here the game is still being played. Now, why do we feel that, a player like Zomato still has a significant advantage here? So the reason we feel that way is because if you look at actually what's happening in the quick commerce, there are three things. You have something called a quick commerce, you have e-commerce, and you have another segment which is called the slotted delivery, where Big Basket, DMart Ready, they operate, where, on a 1 day basis or some hours basis, they deliver you the whatever you have ordered. Now, what we are seeing is the barriers, or, they all three are now converging. The Big Basket or the BB now is now wanting to do quick commerce. Some of the quick commerce guys like Zepto is trying to do something very similar to what a BB now does. Similarly, players like Amazon wanting to be in quick commerce, Flipkart wanting to be in quick commerce. So in this scenario, what's happening is market, which we thought for quick commerce, which we thought would be like growing at 30-40% for a few years and then become like a 20% growth story for like it is in food business, now is growing at 100%. And to just give you a sense, quick commerce as we end this year, which is calendar year December, would be around $6 billion. Whereas the overall opportunity, on the grocery, food, this side is close to around 750 to $800 billion. So, this is a business where the quick commerce and the slotted delivery are already at a much significant penetration. So if all this merges, what will happen is your total addressable market will go up sharply. So while, it is right and market should be worried that, competitive intensity is increasing. At the same time, what is happening is the total addressable market is increasing so sharply that, it's negating that. So it's not like a paint industry where, you have a very low growth. It's a matured industry to some extent. I know in India, everything is a growth industry, and on a per capita, everything looks like growth industry, but it's a relatively matured industry. And, you have one new guy coming with a lot of capital. And, that competition is very different from a competition industry where you are in a very nascent stage. It's 1 year, 2 year old. And, the one with the best business model will survive. So someone like Amazon and Flipkart unfortunately have two different business models, and both of them are already losing money there. And the second thing is, I think, which could eventually turn out to be advantage for Zomato, is like Zomato, if you see the domestic shareholding today is around 50.2 or 50.3 as of November month. Now, the rules for the essentially the rules for retail differs significantly between, say, a domestic and foreign owned. And we believe someone like Zomato, if he were to become a domestic company, would have some significant advantage here. Also, the fact that Zomato already has a cash cow like a food business, where he'll keep getting a lot of profits from, makes this business model more robust. And lastly, I just wanted to mention, like, if you read the Swiggy, the RHP, when they just came out for the issue, for public issue, there they mentioned that 78% of the users they get in Instamart, they have, initially, they have done their first transaction with them as a food aggregator. And 27% of their overall users operate in more than one. So, the cost of acquisition that we call is significantly lower for a Zomato or a Swiggy versus, say, a new player like a Zepto, where, they have to actually do discounting more aggressively to attract more customers. And we have to still see as to, how both Amazon and Flipkart will, be able to kind of merge two businesses and two different business models and be effective here. Just to remind you, when Zomato was getting listed at that time, Amazon had a similar kind of a trial going on for food delivery business, which the after some time shelved because it was not in sync with what they do globally. So we have to see all that, but my sense is that if Amazon and Flipkart were to come aggressively here, they cannot limit it by saying that, I will just do it in 1,000 items, which the quick commerce guys are doing. What will essentially happen is that, they will expose their entire existing business to something like a quick commerce. And then whoever is the most efficient in quick commerce will, in a way, take away a significant portion of that market. So just to, kind of summarize it, I think despite some of these concerns on quick commerce with regard to competition, we remain very positive here. So that was on Zomato, and why we think it's one of the rare pricing power plays. So this is something which if it plays out well, could be, in a way, if you think of in India, it could be something similar to what we had in Amazon globally. Like when you think of Amazon there, at right that time, in its infancy years, it was written off. It was like, it's a loss-making company. There are many interviews in YouTube channel where people have actually made fun of it in interviews with the this thing on why despite making so many billion sales, you're still a loss-making company. Then at that time the view was Walmarts of the world, the biggie guys will just eat them up, and no one really kind of at that time, not many people guessed that they could become so big. So in India, compared to globally, where retail has a penetration of 60-70% on an average 55%, India, the organized retail penetration is around 6-7%. So for grocery and all, so in fact, it's less than 7% in this year. So this kind of a thing where, we have a distinct advantage. Our advantage is that versus other places, we have many cities which are very dense. And another advantage we have is that, the manpower needed, we have enough of that who are willing to, work at a price where, the whole economics of going and delivering and this makes sense. So it's actually a great fit. And, now if they succeed in quick commerce in a big way, then, all this thing about e-com, quick commerce and slotted in some years will become to a lot of extent, they will converge. Now, coming to the other point, which is reversal of post-COVID style anomaly. I have in our prior webinar also talked about this aspect that, the period between, say, FY21, which is post-COVID, to somewhere in June or September, was a period where the market sentiments were very different. This was a market which was similar to, say, 91, 94 or 2003 to 7. This was a very high beta, risk on sentiment, momentum-led short-termism, very broad-based, and a theme-driven market. And these kind of markets, to my mind, does not sustain for a very long time, because the kind of businesses, the kind of companies doing very well, inherently those business models are not such that you can have a structural growth like many of the other business. So we think that the last 2 3 years just opposite of what most of the quality investors look for. They look for low beta. They look for, their first focus is capital protection, not wealth maximization. Long run, we have seen that if you, first thing important is capital protection. The idea is more long term mindset driven. Typically these portfolios are very concentrated. You want to have select companies. You don't want to kind of just spray paint and have 100 200 companies. You essentially then owning the market. And there's a very high bottom up bias where you're looking at individual companies. You're not going by themes or some narratives which are going on. So we believe market style is now moving in our favor. It is visible in our performance in the last 3 6 months, and most of the schemes that we run, where after the 22 23 kind of pressure on performance we had, now it's turning around, and we think it's now going to accelerate. It's also visible in, like, when you look at some of the large caps, like say an HDFC, Bharti, you can see it that some of these companies, the way they are coming back, is showing the shift towards quality as well as towards large cap. So why are we saying we see the key? What are the key catalysts we think are driving this reversal? The first is moderating earnings and macroeconomic growth outlook. Obviously GDP growth rates now below 6. We don't see how it can suddenly start accelerating, or at least not what market was anticipating or building. Then while everyone in markets today talks of just one thing, that we have so much of SIP money coming or the retail flow coming, I think they are not giving enough attention to the fact, or enough weightage to the fact that the supply is today much more than the demand in the last few quarters. When I say supply, I mean what the promoters are selling, the QIPs, the public issues. So I'll come to that as to how now the supply is almost become like an avalanche rather than just a trickle. The bottoming of falling concentration. This is a thing where what we have seen is that market, as I said, in the last 3 years, very broad based. So market has a typical way when it behaves, and when it's getting broad based, then lower you go down the market cap curve, they do better. Like if you buy a 250 micro cap, it would do better, or a small cap, it will do better. And as it moves towards concentration, you will see more quality focused companies, whether it, whichever market cap bucket it is in, or large caps, because that's where you see many of the quality, they start doing better. The other is the growth differential is now reversing in favor of heavyweights. There was a period of time between 22 23 where small caps grew much faster in terms of earnings growth, the way they repaired their balance sheet, and the delta between financial performance of between them and the large caps was very high. We think now that is also reversing, because the balance sheet repair is done, and the growth is now based on how resilient or how strong your business is. And I think the heavyweights are now growing faster. The last point is the valuation disparity between large cap and SMID is continuing to be wide, which makes us believe that a fund like Coffee Can, which is more large cap biased, we have 80% large cap, should have a key advantage. So this was the point, which I was talking about as to why we think during times of rising concentration, large caps do better. So what we see here is, when you see the green line, this is a period where concentration is declining. So if you see November 2 to somewhere in November 5 6, the small cap and the mid cap did better than large cap. Then when the concentration started increasing, the large cap fell only 4%, whereas mid and small fell much faster. Similarly, if you see the green period between, say, 2009 to 10, when again market was in a very broad-based rally, the mid and small, these are all CAGR numbers, and these are Nifty 50 index, mid cap 100 index, and small cap 100 index. So small cap 100 index did almost 100% CAGR during this period. Mid cap did 93, whereas large cap did 58. We see a similar thing in this phase where, it's lasted almost like post-COVID till we think by September, where large cap as a CAGR has done only 23, whereas, mid and small has done like 37, 35%. So if you actually do the numbers like on a 3-4 year basis, if the CAGR difference is like 12, 14%, that's a huge difference in terms of your eventual outcome. But we think that is now turning and is getting in favor of large cap. Lastly, the point I mentioned in this context, the point I mentioned about how earnings, difference is now reversing. So if you look somewhere, during this phase in say 23, early 24, the growth, this is PAT growth. So if you look at the green bar, that's the PAT growth of the top 100 companies. The yellow or the orange bar is between 101 to 250 market cap. And the last one is the market cap from 250 to 500. So, the growth was, higher here during this phase. And then since then, it's been reversing. And in fact, in this quarter, the small caps actually, like the 250 to 500 bucket has actually fallen. The earnings have fallen 28% versus say flat for top 100 companies. So, the earning difference which was there before is now reversing in a big way. The earnings cut also, if you look how much has been the earnings cut for these three indices, the earnings cut for large caps have been around 2%. This is for financial year 25 and 26. Mid caps been around 3%, whereas for small cap, it's been much sharper between 8% for this year and 5% for 26. Uh, Obviously, this is like, when at Ambit, we have different kind of funds. We have large cap focus, we have mid cap, we have small cap. And our focus is similarly to focus on quality concentrated holdings. So we believe at all points of time, you will find that 20-15 companies in different buckets where, you can have superior kind of performance versus what the overall segment is doing. So our performance has held up, and when you look at the overall growth, it's been on the stronger side. Now, the last point on this, again, the other point is the how the supply is now outstripping the demand in financial year 25. So if you look the green bar, it's the total equity supply, and the yellow bar just gives you an indication of how much has been the domestic promoters. So all the promoters have been aggressively selling. The supply for total equity is increasing. In fact, the total supply for equity in financial year 25 till now is around 7.5 trillion, of which 1.5 was secondary sales by domestic promoters. So this is a distribution of where the supply is coming from. So, all the baskets, you have strong supply coming in from IPO rights, from a foreign promoters and private equity selling, domestic promoters selling, secondary sales in the ECM, that is, bulk deals and so on. So we feel one needs to be concerned, and concerned in the sense of this, that, what has been working here, the theme-based, broad-based, and risk on high beta, they may be in severe risk now, because I'll just come to the valuation point. The differential in valuation between say the large caps and the SMID is still continuing to be very high. So if you look, this is data from November 2006 till now. Never has the valuation difference between two been so high. So it is now almost reaching your second standard deviation kind of a thing. And, it's almost 40% higher than prior peaks that we have seen during the prior peaks that, bull peaks we have had, say 2007, or, you look at more like the 16, 17, we have surpassed all of that. So I think it's a key risk here for the, very broad based, high beta risk on sentiment kind of stocks. So with that, given the time constraint, I'd like to quickly take you through this. Like, this is a time where you have to be very stock specific, because if you look at the overall economy, there is definitely some kind of a cyclical slowdown, which is visible. GDP has been falling. It's been led by largely manufacturing, which has, kind of been weak. People attribute this weakness more to, the government expenditure coming off sharply because of the elections or whatever reason in the first half of financial year 25. But, all these things will kind of put more pressure on companies which are, riding on some theme or some kind of a story. So this would be a key issue. Similarly, the household leverage is now almost similar to the prior peak, which was at 44.7. We are right now, reaching almost there. So this is again a very key risk because, the second exhibit shows that this is again a slide we have from Avendus. So this is if you look at the total EMI burden on a household, that's been increasing. So, a lot of growth we saw in the last 2-3 years, whether it's in tourism, whether it's in automobiles, and a lot of it's been homes, or a lot of them have been driven by very high leverage by households. And at the same time, your income levels have not gone up so much. So that is why we are seeing the kind of pain we are seeing in the overall consumption names and so on. The real wage, as I was mentioning, is not growing so fast. That's a key issue. Even when you look at the hiring, these are the numbers we take from Naukri, JobSpeak, the data that they have on the website. So other than this AI and machine learning kind of things, everywhere else it's been negative. Like banking, financial, it's showing -14. Retail is 11, 9 months. Telecom is -8. So, it's a very weak environment. The point behind mentioning this is that during these times, unless you are a company with very high sustainable moats, which is what we in a ways refer to when we say pricing power and so on, you will be in trouble. The broad numbers again, both rural side and urban side, there's pressure. So lastly, to come to our performance on Cafe Can, very, very briefly, there's just one point I wanted to mention here. I didn't want to go too much into detail. See, this fund's been there from 2017 till now. So if you look at the period pre-COVID, in most of the years, we have had like 10% or 7% kind of an alpha. So it is these two periods which I have been mentioning, which is the 22, 23, because of, the kind of stocks going up, which is very deep cyclical, the PSU led, or many of the ones with very, the promoter background and all issue or so on. So that impacted the performance. As we speak, we are back to like 4-5% alpha. And we think we are reaching a phase where, if the overall style starts favoring again quality and again pricing power, the kind of, I alluded to that, the investing environment is again moving more towards concentrated in our style, then this should be of a great help to us. So that was some of the things I wanted to discuss. I'm happy to take any questions that you all may have on the same. Over to you, Akshara. Thank you.
Thank you, sir. Thank you for the insightful presentation. I must say that if any new age company investor is a part of this webinar, would definitely, feel it very interesting because it was a lot of examples taken out there. And this, whichever stocks which was spoken or taken in this webinar, I would say there is no kind of recommendation either from Ambit Asset Management nor from PMS Bazaar.
Yeah.
That's a
I
disclaimer.
would maybe take one line here. The only reason we discuss Zomato is more in the context of when we say pricing power. I wanted to explain it. We've been owning it like it's 140% up for us. It's definitely not a recommendation or anything like that. It's just how to think about a company and the long-term way we think of it right now.
Yes, perfect. That's true, sir. And without any further delay, let us move to the question and answer part. Now that we spoke a lot about Zomato and as a stock, so let me take a question on that first. Talking on the quick commerce part, yeah. The major or a big e-commerce sites like Walmart or Amazon, it can be for that matter, they are entering into the quick commerce section now. So what are the risks? Of course, you have spoken more on Zomato, but what are the risks, companies like Zomato can face? Because it's a primarily a food delivery app. And when it combined with Blinkit, then it entered into the quick commerce part as well. So how the competitive advantage for Zomato here?
Yeah, so no, it's a key risk. I don't want to, sound that, one should not take that seriously when players like Amazon, Walmart, they want to venture into something. It should be a very, something which you should take very seriously. And, these are companies with such deep pockets and they already have such a strong presence in India. So at no point I'm trying to undermine and say that it's not a very formidable risk that these companies are facing. I kind of alluded to it in my presentation also. It's a very key risk. That's why if you look at the porter forces I did separately for quick commerce, almost everything is red. Competition's increasing, your supplier power, buyer power, everything is just the opposite of food business. But the only reason why would still we want to hold our positions in Zomato and not like too afraid of these things, there's two things which I mentioned. One is that what we feel is that today all the businesses are converging, like your e-com, your slotted delivery, your quick commerce. So when we modeled Zomato 1 year back, we assumed that quick commerce is something which will grow at 40-45% for a few years, and the overall opportunity size that we saw in 5-10 years was significantly lower than what we think it can be today. So by venturing into, so there are two ways you can look at it. I could be biased because I hold the stock and I'm positive on Zomato, but there are two ways you could look at it. One is you can assume that, Zomato and Swiggy are the incumbents, and, players like Flipkart and Amazon are coming and attacking them. The other way to look at it is actually, the incumbents in this business are the Amazon and Walmart. And by innovating and coming up with this business model of quick commerce, it is these guys, these two, three guys, which is Zepto, Swiggy, and Zomato, they are in a way disrupting the broader e-com business, which is a multiple times bigger than, what a quick commerce business is. Because quick commerce business last year was 3 billion. Today it will reach 5.5, 6 billion. So it was several multiple times bigger, like, almost 8-10x bigger. So what is happening now is initially the view was that only 10-15% of the e-com business is susceptible to quick commerce risk. People said maybe, you would just order a yogurt, or like if you're very urgent, you would order a battery from, say, a quick commerce. But why would you order XYZ? But today, the SKUs these guys have is reaching 10,000. Now, my sense is that, if Amazon and Walmart were to suddenly now come here, they cannot come and say that, look, we will do it only for 1,000 SKUs, which quick commerce is giving, and they have the highest sale. In a way, they will expose their entire business to the quick commerce. And, they have to service across the board in all pin codes versus these guys who are, very selective and trying to do in select pockets. So I think there is one way of thinking that maybe, this is again, as I said, not a business like a paint business where, the industry, the pie itself is growing at, say, 5-10%. And now a new guy is coming in and is so aggressive that he wants to take away a part of the pie. Here we are talking of 6 billion as quick commerce today, and the overall opportunity being like 30-40 billion in the next, say, 10 years, 7 years, and so on. So that kind of a big opportunity, even if other guys take a portion, so it will not be a duopoly like a food business where there'll be just Swiggy or just Zomato. But even if there are 3-4 guys here, and if these companies can grow at like something like 30-40% on a very long term basis, and it become a very big business for them, there's still a lot of value to be earned. And I think they have an advantage here. The way they have cracked the business of quick commerce, like using the riders and so on. They already used to dealing with 3 to 3.5 lakh riders, 2 lakh restaurants. They already know how to do this. Whereas, someone else may not have, like they have much bigger supply chain. On a supply chain, no one can beat a Walmart or a Amazon, but they're not, used to this particular aspect. So, I would not be too frightened by the fact that, the competitive intensity is increasing, because I still see that they can grow. They have a business in food where there'll be a consistent growth. There's still no major risk there. So that is like having an organic business which can support you in the next few years. And I think they have the first mover advantage in this business. A first mover advantage is a key one. I think these guys are like, I know it's sounds funny, but they are some quarters or a year away, and that year is making a big difference. Like, if these guys are 1,000 and they are now saying we will do trial, so they have that, they've lost that first mover advantage. And
Mhm.
lastly, the point which I mentioned with regard to regulation, all these companies have been openly talking. If you look at the interview with, one of the third player, or even if you look at, why some of them are raising cap. So, they are trying consciously to bring down and become a domestic company. So you must be aware that, foreign companies cannot do inventory-led model. That is not to suggest that quick commerce companies want to do this. But whenever industry is growing like this, there is bound to be regulatory issues. It will not be a smooth walk that you will keep growing at 180% and there will be no. So government will come up with different regulatory challenges. There'll be so many issues, and I think if you are a domestic company, those regulatory challenges will be less versus if you're a foreign held company. So just to summarize, I take your point. It's a key risk that such big players, and it's not just them. Actually it's the Tatas through big basket. It's like you never know what Reliance will do. So if you think of it, it's very, very scary as to what will happen them. But I still feel that the advantages these companies have is significant. The market is expanding, and when I really do a game theory analysis, to me it seems that for those guys to now come in organic will be very difficult. The only way they really, if they want to be here, they may have to look through an M&A route. So whenever I do my thinking across on a game theory perspective, I feel that Zomato is in a key advantageous position, and I'm okay with the near term risk of 1-2 year because of increased competition.
Got it, sir. And as you mentioned in your answer, saying that how the quick commerce, have seen its growth and how it's going to see its growth. It's very much true because in every other household in India has a Zomato app which inbuilt in their phone, irrespective of it. Also, not only in urban areas but also in the rural part of it, they have the reaches more when compared to any other big companies.
I think it's just the mindset. Like, when we first started using Blinkit, our sense was then only if you wanted to order a yogurt or something like that, you go to Blinkit. But today, we order batteries or many things which, a charger, which earlier we used to order only through an e-com site. And today, at least we search, like, someone wanted a calculator very quickly for exam next day. We searched, is it there? Earlier it was unthinkable that you would go and search for a calculator on a Blinkit platform. But so that's why I'm saying all this is converging. And once Amazon and Walmart jump into it saying that, we will do this, it will be, I think, very difficult for them to limit it to only those 1,000 categories where they think it's easy. They will expose their entire tail. And, obviously they have like 2 lakh, 3 lakh SKUs versus these guys who have 10,000. But, that's the advantage. They can make 10 to 11 and choose what they want, whereas those guys may find it difficult that how do we deal with. So it's the same problem which they had when they went online and they were brick and mortar thing. So they had those difficulties, and let's see how this plays out.
That's true. And one more question is that, though we spoke a lot about, pricing power advantage, do you think this pricing power part, do you think it is only available in matured companies, or is it available in some other players as well? What is your view on it?
Yeah, so typically, your pricing power to be visible, you would typically, look for a company where, they've exhibited it over cycles. Because when does pricing power become visible? When, you see some shocks in economy, or where raw material has some issues, or, there's increased competition and they're still able to maintain it. So I would think that if not matured, it needs company with some lineage and, a longer history. But often what happens is that we shouldn't make it like a rule or something. Often what happens is that the qualitative aspects are so visible in a new company. Like if you wanted to wait for those things to be visible in some of the big 5 6 companies, and say, hey, I want it to be visible over 10 years, and only if I've seen it over 10 years will I buy a Nvidia, many of these companies, I think you would have missed an opportunity. So if you take a case of some of the new age companies, it's very visible that the kind of pricing power they have is these companies, like, if they charge you 10 rupee on platform fees, then, on an average order value, which is 400, 10 rupees is like, almost 2.5% they are charging you. And these are businesses which, on a PAT margin, even if they attain that. So that's the kind of pricing power. How can you, like, very few companies can just pass on the delivery charges. In the last 2-3 years, the kind of charges they've passed on to a user without impacting their demand in a big way has been crazy. And again, it's a duopoly in the food side, at least, if not.
Yes, sir. I accept with that. And when you said during the cycles, so let me take one question from it. You believe in quality as an investment style, correct? So there are, in some cycles, there are chances of having low quality but high beta. So how does that discipline with your an Ambit investment philosophy here?
Yeah, no, it's a great question. So this is what we faced between, say, 2021 to 24. where obviously the market mood was very different than what we were trying to practice, and to some extent it impacted our relative performance and versus benchmark. Our focus was always that capital protection and on a long term basis those remain, but we were not able to match up on that. So I think this has been a learning exercise for this, as to even during these phase where initially we thought this could be for 6 months, 1 year, so you tend to ignore, but it could be longer. I think even during those phase, the change we did in the fundamental thing in say a coffee can, where we said 30% of our portfolio companies will be what we call is future coffee can companies. So you have to then like within the framework you are doing, you have to be innovative around it. I don't think for any investor to suddenly say that I'll change my style and just follow the momentum because I don't want this. Divergence to happen. I think that's not a right thing, because asset management is a business where you build your what you stand for, your philosophy, only when it's tested over decades and so on. That because these businesses are very long term. So I think during these phases you have to be more innovative than perhaps what we were in the last 2 3 years. Though we learned from it, and I think it's possible to address even those phases by being innovative and finding different aspects within the same style. Like if not, we were very obsessed, I would say, with finding those quality companies only in what we called as consumer related companies. But often you could find similar characteristics even in non-consumer companies. So those were the learnings.
And also for the pricing power advantage for the that as a concept, it is comparatively not new in the global terms. Correct. So in the US, you have it even more an established format when compared to in India. So where do you see the structural differences here?
No, so the data we showed you, like pricing power as a factor or as a form of characteristic works across. You will find companies with pricing power across the globe, and they are companies which are typically very non-glamorous. You will not hear much about them. These are companies which will keep on performing in a stable way. Like what is the pricing power companies which immediately comes to your mind? Like if you think of Crystal, have how many times do you hear on CNBC people talk of Crystal or recommend it or suggest that it's a great company to hold? But there's so many companies like that everywhere, where they are very, they don't get so much of fancy, but they keep giving you better returns than most of the other companies. Even today, if you look in capital market side, infrastructure side, like companies like say CDSL, CAMS, KFIN, people don't see them today as companies which can potentially one day have pricing power. But tell me one thing, like if it's a duopoly, something like a CAMS or a KFIN, you are catering to 45 or maybe 20 large, 15 large MFs who today cannot do it on their own, because if they do their registrar business themselves, their cost will be 2x or 3x. So, at some point they will be in a position to flex their pricing power. So sometimes these pricing power plays are invisible, and they are the strongest when they are invisible. When they become visible to everyone, like say something which is most famous for a pricing power would be like a Nestle or a Titan. I think then you start having more risk, because everyone's trying to do something similar to in every aspect to what a Titan does, but at a lower down on the cost. And so they have to be more and more innovative. They have to look for growth in new areas. So maybe Titan today, for similar growth like what they have done in the past, will have to now focus a lot more in going international when the competition is increasing in India. But whereas many companies which are non-glamorous, both globally and in India, benefit significantly from that.
Got it. Now that you've taken a lot of names, stock names, the cycle get reversed. And what specific opportunity do you see in sectors or stocks when which previously favored out, and during the high beta rally?
So I think within that also, what you mean is like in the high beta rally companies which have done well, do you find opportunities? So within that, what also happens is companies often being in a commodity business or something, they still kind of are able to sometimes make up a business model which, is less and less commodity driven, becomes more predictable, and they in a way have significant advantage there, either through the cost side or differentiation side. So whenever you find such company, you have to look, like I would say a case like maybe some years back everyone would have thought of say ABB, like a very cyclical company. It was looked at as industrial, very cyclical. But if you look at the way they have changed the entire business model, removing the very long gestation one, focusing more on the short duration business orders, and then within that, predominantly product led. So whenever you see this kind of a transition, again, it's an opportunity because market sees it as cyclical, whereas you recognize that, the business model is changing. Another great example I could give is, say, Indian hotels. Indian hotels is perhaps an example you could have given 3, 4 years back as one of the businesses you should definitely avoid, because hotels is such a bad business. Like every cycle you put huge money, you take debt, your balance sheet goes out of this thing, and then the moment the downturn comes, your balance sheet gets in an issue, your return ratios, everything go for a toss. Now what they've done is they've now more than 50% of their rooms and all is coming through managed rooms. So they've suddenly made a very asset heavy business into an asset light business. So wherever you see these kind of transitions happening or a business model changing, actually they are the biggest opportunity. So one of the advantages is when you ask what is your learnings from, say, 21 to 2024, when these sectors did very well. I think one of the advantages is that you recognize that even in the midst of, like, earlier we would often write off some companies and say, "Ye to hame, we don't look at it only." But you need to be looking for this kind of a turnaround or a metamorphosis where something is completely changing. And if you can identify that, then the returns you will make there will be much, much more than what you will make in a proven pricing power company.
Got it, sir. So let me move on to the coffee can investing questions, because and also the questions which is following on the podium. We have a question from Divakar. Performance was not great. You have addressed it. However, what kind of returns can I expect in next 3 to 5 years perspective if I invest?
Yeah, you rightly mentioned that, on the performance front, in the last 1 year itself, the difference is visible because first style is changing, and also we've just not waited for market to turn in our favor. We also consciously gone ahead and made some changes, made some innovations, which kind of makes us more apt across cycles. So one of the things we have tried to do is that, even though we definitely believe that, you have to stick to a philosophy, what you have promised across, we are trying to have products where, we kind of address this risk of not having, deep cycles or fluctuations within that, which, if you do some innovations around how you identify it and so on, you can do that. The other thing, when you say what is the future outlook, of course, we cannot talk about potential. That's not something which is, we could do that on a as per the SEBI thing. But the way we construct portfolios is that, we think of it as a something that, if an index is giving X and if my cost that we are putting is X, we think that, the only way we will be able to kind of attract or we can be viable is that if we are able to do 4-5% above that. So it is not what we can what you should, but it's what we aim for. I would say so. As a fund manager, I aim to do the index plus cost plus 4-5%, because that's how I feel this would make some sense to investors as such. So that's our aim, not something we kind of are predicting or kind of suggesting will be the outcome.
I think that has answered Divakar's question. Most of the questions are answered, but let me take one last question for the benefit of the time. When you say large caps will do well, do you indicate a flattish market?
No, I mean, to be frank, I will not say that, I disagree, because see, look, what's happening is valuations clearly today are very close to prior peaks and valuations are high. Now, earnings growth this year will be like, less than high single digit. And the year post that also, I would think that when you take a 2-year CAGR, we would be still that 10%, 11% type. So if valuations don't have an upside and your earnings growth, then it becomes a very stock pickers market, which is where, which is where, our style of investing works, because, we typically have 15-20 stocks in our portfolio. And you think that, in a market like India, it's always possible to find that 15-20 companies, which in a way are uncorrelated with what's happening in the market. So we think this is while for the broader market, what you're saying could be true. We hope it will not be for us, because our style would allow us to do what we have done in some of these prior periods when such a challenges come.
Okay, thank you, sir. I think even that answered the question. With that, I've come to the end of the session. And I need to thank you from behalf of PMS Bazaar to be very patient throughout 1 hour and to explain us everything in detail along with the examples. Thanks a lot, sir.
Thank you. It was my pleasure, and thanks so much, PMS Bazaar, and Akshara, and also want to thank all the participants for taking time out. I hope some of these discussions were of use and interesting. Look forward to having another discussion soon. Thank you.
Thank you all.